Hello, friends, and welcome to my YouTube channel Simply Stocks. And today I'm going to talk about Amber Enterprises, which still can become big from these levels, and it has run up over time. But let's understand how it can become even bigger and what lies ahead. So, let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position, any share that I talk about should do that with their own due diligence and research. And I'm not in favor or against any company that I talk about. Before I talk about Amber Enterprises, here's a small request that kindly support me on Patreon, and once you do that, it will help me grow the channel. It will help you also ask me questions in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and a number of podcasts that I put up from day to day. For detailed market or company talk or one-on-one discussion you want to have with me, you can directly email me. Now about the company, Amber, established in 1990, manufactures a number of consumer products, have contract manufacturing from a number of brands. Their clients include companies in air conditioning, refrigerators, and automotives. And the market cap of the company is between 5,000 to 6,000 crores. Have nearly all AC firms under its ambit, and it has presence all across India. Basically, what Amber Enterprises does is contract manufacturing for making products for different kind of brands. So their business is similar to Dixon, but I believe Dixon is a better and more bigger company, but the valuations are expensive there. And I have always maintained that Dixon is a better play than Amber. But currently, I believe that with the way Dixon has moved from 11, 12,000 all the way to 19,000 or so, it is more prudent to look at something like Amber now. Although Amber has also run up, but slightly it is, you can say, undervalued compared to Dixon. So the sector as a whole, the complete sector has done extremely well and may do well for the next couple of years. And that's why the surge, there is the backup of the PLI, etc., that I'll discuss later on. But basically, this is the kind of business that Amber has. So the margins are not that great. So you have to understand that margins for both Dixon and Amber is not that huge, and that's why most large analysts do not talk about these companies, and they talk about original manufacturers rather than going with ancillaries like this. So this is similar to these two companies, Dixon and Amber, are similar to you can say auto ancillary companies of Motherson Sumi, or you can say Endurance Tech, etc., which have lower margins, which do not have pricing power, but still are one of the best in their own business. If you look at the financials of the company, then these are Q2 numbers. Probably Q3 would have come in, but when I made this video, they were only Q2 numbers. So September numbers were not great at all. Sales dropped by around 33%. Profit dropped by 75%, but the debt is low, and sales and profitability dropped on the back of the business not being there, because their major business is in making AC. So now the big thing will happen, or the big surge will happen once this you can say the March and the June quarter numbers would come in. Those will be huge, and that is why I bring to you this stock on a Saturday, that now the surge could happen immediately over the next 2 3 weeks on the stock, and we could see good 20-25% upside in the next 3 4 months, and maybe 50% upside over the next 1 year. Not paying dividends is a major concern for investors, but I believe the best months for the company remains, you can say, between February all the way to September, or you can say July, August. And you need to understand that in the September quarter, you have July, August, and September. So in July and August, there was partial shutdown of the country. Partial, you can say, the pandemic was still there, it wasn't gone. But by now, by December and all that, things have improved manifold, and I believe that AC companies are set to do extremely well from February, March onwards, or from these months. So that is where one needs to keep an eye on. Debtor days of 105 is also not that great. Return on equity of 10%, operating profit margin of 6%. As I explained, profit margins would remain in the single digit domain. I have an understanding that Dixon has a net profit margin of around 3.5%. So there is nothing that we could do about it. These will may not increase that much, but the sales is the big thing. So if the sales keep on expanding, then profits will increase. So that is based on sales, but the margins may not move that greatly. So if you look at the performance of the stock performed well since its listing. So listing was good, and then it has slowly, gradually moved up. There was a time for 2, 3 months when the stock did not perform that well. Otherwise, the stock overall has done extremely well. Numbers have remained decent, and over the last, except for the last quarter or a couple of quarters, numbers till FY20 or early part of FY20 have remained robust. Stock fell 40% in the fall of February March, but has recovered very well from those lows and has surged past the, you can say, the highs of 2020 January, and is doing well. Now the biggest beneficiary of the PLI schemes would be these electronic manufacturing companies like Dixon and Amber, and that would come to the fore over the next 2, 3 years, where they get tax incentives, where they get revenue incentives, etc. And this will also kick in FY22 for these companies. So the numbers are set to remain robust throughout FY22, and probably most part of FY23 as well. So contract manufacturing companies have come under fashion, and we have seen even in the pharma domain we are looking at API manufacturing companies. Then we are looking at auto ancillary, again contract, it's like a contract manufacturing firm. So we are looking at those plus now we are into electronic manufacturing, and we have these two companies. So this might just be a trend that could continue for at least the next couple of years, and that is the time frame I'm looking at these companies. And a consistent growth is possible over the next 3 to 4 years. So why I believe it is a buy on decline. Market cap is low for such a business. I believe the market cap, as I have told many times and I have said many times, that Dixon at 3000 crore market cap was extremely low, having a very low market cap for the business that it was doing, and it rose to now something like 22,000 crores. I believe this also has a potential to go to 20 to 25,000 crore market cap over years. Future growth is looking very imminent with the kind of business that it is into, and it is expanding its business. So it is into AC, it is getting into refrigerators, it is getting into chillers and other kind of, you can say, product brands. And remember that this is also a big consumer brand. So rather than looking at a purely, you can say, FMCG, we need to look at other consumer brands which are in the mid to small cap range and which could do extremely well, and this falls perfectly into that category. It boasts of major AC and automotive brands. It's into automotives as well. And currently you have an understanding that even automobile ancillary and automobile is running. And I have also explained that earlier as to why those things would also run. So once growth comes back here in India, and with the kind of numbers we have seen in Motherson, Sumi, etc., all these sorts of companies will perform, and it would be a 2, 3 year of dream run for these companies. It is a huge consumption play, debt is extremely low, and there is heavy institutional holding. So this is a big fillip. So institutional holding is huge, promoter holding is pretty huge, and there's 9% free float. Although you will say that 9% is bigger than what we have in Dixon. In Dixon, it's even lesser. It's close to 4 5%. But even 9% free float is pretty good. So all in all, it looks at top company to give you big returns over the next couple of years. So as I explained, a huge consumption play with heavy institutional holding. The company could be a decent buy from a 2 years perspective, but don't buy it from a 2, 3 months perspective. Things could change very quickly because the valuations have gone up. Although I still believe it is undervalued compared to Dixon, I still have an opinion that things could go up and down over the next 1 year, and there could be corrections. So you could buy and the stock may correct. So have a good 18 to 24 month time horizon. So, what needs to be done, in my opinion, buy on major declines, look for some sort of a decline in the stock. Like we are seeing, we saw that in couple of chemical companies I've talked about on Patreon. We have seen with auto ancillaries as well. We have seen that with escorts. I mentioned that categorically in my live chat that the way escorts fell on the 1st of February, and you look at the prices now. So we are seeing with specific companies that there are falls, and people get scared. People think that the story is over, and then the big surge happens. So wait for such kind of declines. But I believe that summer season could be big, and this could be a positional play for the next 6 months as well as a long term play for the next couple of years, but not for 1 or 2 months. 2400 would be a very good level to accumulate the stock, and keep track of numbers. Have at least a 2 year time horizon, and if possible have a 4 to 5 year time horizon. It can still be a multi bagger from here. It can still be a 5 digit company over the next 5 6 years. That's my assessment. But at the moment, let's go with a 40 50% upside over the next 1 year on the stock, and have less than 10% exposure into such stocks. So this was my video on Ember Enterprises. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away when I post it. Thanks a lot for watching.